This explainer is made possible by Hall Jacobs, a capital markets firm placing senior and mezzanine debt, preferred, participating preferred, LP, co-GP, and JV equity since 2006. Welcome to the explainer. For anyone watching Salt Lake City's multifamily market, one word has just dominated the conversation: supply. But while a lot of people see a glut, the data is starting to tell a totally different story, one of opportunity for investors who know where to look. Today, we're getting past the headlines and digging right into that data. So this really frames the big question on everyone's mind, right? Is this massive flood of new apartments a huge red flag, a warning sign, or is it actually the setup? The perfect conditions that create a strategic entry point before the next cycle really kicks off. Well, the data is pointing pretty strongly toward the latter. All right, here's how we're going to break it down. We'll look at how that big supply wave is finally calming down, how that's pushing the market into a new phase, what that means for the value add play, the acquisition window that's opening up, and then the path to recovery. So let's get into it. Okay, first up, that supply wave. The peak is definitely in the rearview mirror, but its impact, well, that's what's key to unlocking the opportunity we're seeing right now. So, get this. As of late 2024, we were looking at over 11,000 units under construction. That's a huge 9.5% jump in the total inventory. And that right there, that's the core pressure point that's been squeezing rents and occupancy across the board. But here's what's really interesting. This supply shock isn't some broad, even wave. No. It's incredibly concentrated. More than 40% of all of these new units are packed into just two spots, downtown and the South Salt Lake/Murray area. And what that does is create this super intense localized competition, especially for all those shiny new Class A buildings. But here's the critical turning point. The good news, that pipeline is shrinking and fast. With capital costs up and lending getting tighter, new projects just aren't breaking ground like they were. So deliveries for this year, they're projected to hit a 5-year low. This slowdown is exactly what the market needed. It's giving it some much-needed breathing room. And that slowdown in new supply is pushing the whole market into a transition. We're moving away from just trying to absorb units and into a phase of price discovery. And, you guessed it, new opportunities. Okay, this is the key takeaway here. The dynamic has officially flipped. For the first time in more than a year, demand, that's net absorption, is actually outpacing new supply. This is the inflection point we've been waiting for. It's the beginning of the rebalance. Now, you see that shift translate directly into pricing. The average price per unit dropped about 15% last year. But look, for those of us in the industry, that's not a sky-is-falling number. It's not a red flag. What it really reflects is a change in what's actually selling. We're seeing more older, value-add assets trade hands, and that naturally pulls the average price down. More importantly, it creates a much more attractive entry point. So with all this going on, a really distinct strategic lane has opened up. You've got this flood of brand new, expensive Class A units, and that's created a clear, compelling opportunity for value-add investors to focus on older, more affordable properties. So why is the value-add play so powerful right now? Well, it's pretty simple. First, it taps directly into the huge demand for affordability, which all that new Class A stock just can't touch. It lets you leverage those lower acquisition prices we just talked about, modernize the aging Class B and C stock, and capture a way bigger piece of the renter market. Plus, you can often target higher initial cap rates. It just makes sense. Okay, so when you put all these pieces together, the slowing supply, the positive absorption, the price adjustments, what you get is a strategic acquisition window. And the key word there is temporary. And look, this isn't just our take on the data. This is the sentiment we're hearing from people with boots on the ground. The consensus is building that the time to make a move is now, before this recovery really gets its legs and pricing starts to climb again. So the playbook is becoming pretty clear. Step 1, you target those Class B and C value-add assets. Step 2, leverage the price adjustments to get in at a favorable basis. Step 3, capitalize on the fact that debt markets are starting to ease up a bit. And finally, step 4, you position your asset to ride that recovery wave as it comes in. All right, so what does this path to recovery actually look like?
This isn't just wishful thinking or speculation. The data is pointing to a really clear, positive path over the next 18 to 24 months.
This timeline really grounds the whole investment thesis in data. The forecast shows rent growth turning positive right around the middle of this year. Then, by the end of 2025, we're expecting occupancy to climb back to 92.4%, with annual rent growth hitting 2.5%. And then, as we head into early 2026, we see that rent growth accelerating even more, pushing past 3%.
And it's so important to remember, this isn't just a cyclical blip. This recovery is happening on top of an incredibly strong foundation. I mean, the long-term story for Salt Lake City hasn't changed. You still have the powerful drivers, the young demographics, the pro-business climate, the high-wage job growth, that continued influx from the West Coast. All of that is still there, and it's going to support demand for years.
So it really all comes down to a question of timing. The opportunity to get into assets at a great basis, it's here, right now. But as the debt markets continue to thaw and this recovery story becomes the consensus view, you know what happens next. The big institutional capital that's been sitting on the sidelines is going to come flooding back in, which leaves every investor with one simple question. How long will this window of opportunity actually stay open? This explainer was made possible by Hall Jacobs, a capital markets firm placing senior and mezzanine debt, preferred, participating preferred, LP, co-GP, and JV equity since 2006.